Hello, everybody, and welcome to Wall Street Hackers, one of the most exciting stock programs and investment programs on the Pod TV network, where we beam out to Facebook, LinkedIn, Twitter, Twitch. We're on Roku, not the Roku channel. We have our own channel on Roku, as well as Amazon Fire. And like I said, we discuss the markets, and here we'll actually discuss the quotes of the week, the stories of the week, Peter's picks, and have a panel discussion all within 30 minutes. And with that, we're going to bring in the hacker himself on Wall Street Hackers, person who received his bachelor's degree at UCLA, and I understand they're having issues there, a law degree at University of Miami, and his master's in business administration from NYU. Then spending 17 years in New York City, the big apple, working in this investment world. He now brings enlightening issues to the forefront that we're going to listen to today. And with that, we'll bring in the hacker himself, Peter Bennett. Peter Bennett, welcome to your show.
Hey, Nick, you're right. There's a lot of chaos at UCLA and other places, too. It's a little crazy what's going on in the world today. Anyway, welcome to Wall Street Hackers. We have a new show most Thursdays and Saturdays, starting at 1 o'clock, depending on your distribution channel. And we always start with the markets. And this week, I'm going to start with a quote because it sums up at least part of what's going on in the markets. We'll discuss a little bit more about the markets after that. So this is from Barron's Daily, Tuesday. Amazon, AMD, Supermicro earnings tell investors the same thing. It's bad news. Demand for AI is still strong, but the stock market can no longer rely on the boom to ride to its rescue. Three well-established AI players, Amazon, AMD, and Supermicro Computer, reported earnings late Tuesday amid lofty expectations. The results were pretty good, but the initial market reaction was one of disappointment. Only Amazon's shares managed to climb in after-hours trading, and not by much, despite strong AI demand. The market appeared in the mood to punish missteps and reluctant to reward successes. So basically, a lot of information is priced into the market, which is the way the market works. So we're not surprised that, as a bridge, that the mood of the market is not perfect because there is a lot going on and most of it isn't too good. First of all, besides the fact that the good news is priced in on tech, a lot of it, although tech is speculative at this point, but it could go much higher. I wouldn't be surprised, but a lot of that, they're still priced for a fair amount of perfection. Number two, of course, even more inflationary data this week. We received data that wages were up 1.1% in the quarter. That's 4.4% annually. And that was an acceleration from the prior quarter. That's the thing the last 3 months, and now Powell's admitting it. A lot of the data is not going the right way. And that didn't surprise us. I mean, that was back to the fact that energy has been going up, which we predicted, and it's no longer helping. It's hurting now. So the third reason why the market isn't in a good mood is because what we call the delusionary market for 1.5 to 2 years about rate increases has finally hit the fan, and basically the market now is split on. If you read marketing material, excuse me, if you look at the media, financial analysts, things like that, you'll see that it seems like there's a big split. A lot of people are saying we need a rate increase. We're going to have a rate increase. You see a lot of people saying we'll have a decrease, but it's certainly not, we're going to have 6 decreases or 7 decreases. So it's really split, and Wall Street Hackers is predicting very little change this year at all in either direction. The Fed cannot raise rates a lot, or almost, I believe, even a quarter point or more, certainly more than a quarter point, because of regional bank crisis that's going on. I think it was First Republic just declared collapse. I believe it was bankruptcy, largest one since Silicon Valley last year. And the Fed doesn't want to start rolling up regional banks and cause a banking crisis. On the other side, they can't lower rates a lot because of inflation. And so they're kind of between a rock and hard place. So they'll talk. And if you listen to their talk, it's so ambiguous these days for very good reasons. They don't know. They're, quote, data dependent as always. The fourth reason is government spending is totally out of control. We'll be getting into that again more in terms of the long range investments that you might be thinking about. And finally, unemployment. Oh, two more. Unemployment rates remain below 4%, which is near historic lows. So that's not going to help inflation. And finally, long-term bond rates have been moving higher. It's been pretty steady. They've been drifting higher, and especially in the last 2 months. So yesterday, the 30-year Treasury was at 4.9%, which is a decent return for almost risk-free. They call it risk-free. And I'll be using that term. So when I say risk-free, I'm not counting inflation risk, but other than that, it's risk-free. So on March 28th, it was 4.4%. So it went from 4.4 to 4.9 in 2 months. On January 2nd, it was 4.2. So suddenly there's an alternative to equity investments. And you say, wait a minute, I can get almost 5% in a risk-free product. And maybe I don't want to take risks. Retirees, a lot of people don't want to take that much risk, or they want to take less risk. So this is a possibility for people that, 2 years ago, I remember you could get like 2 or 3% in a muni or a treasury. It was really slim pickings, and it forced people into equity. So we'll be getting more into bonds this week, and next week we're going to be discussing municipals this week a lot in terms of our strategy, and then treasuries next week. Then we'll get back into some non-energy dividend picks in the following weeks. So most interesting stories of the week. We need a graph here. Okay. So President Biden, interesting story number one, President Biden has said the Trump tax cuts, quote, are going to expire. If I'm elected, it's going to stay expired. He also said the legislation, quote, exploded the federal debt. There's all kind of comments they could make about President Biden saying this, but I'll let it speak for itself. So here's a chart of the federal tax receipts, and you can see I marked the Trump tax cuts, which were around 2017. And take a look at this chart a second. What's noticeable? Well, and by the way, this chart is from 2000 to 2028, so it does include a couple of years of projections. But what is noticeable about this? Graphs rarely lie. Numbers don't lie much. And so it's an acceleration of revenues created by the almost certainly created by the tax cuts. And you say, oh, maybe it was something else that created it. But if you look at history, it's very clear. John Kennedy cut taxes and federal revenues went way up. Ronald Reagan cut taxes and revenues went way up. And back then, by the way, historically, the Democrats said, oh, but the deficits went up. But that's because he spent a lot of money on the military because he was trying to get Russia to collapse. And he basically did that. So there's a number of other points about this. Another point is, if tax receipts are up so dramatically and government debt is up so dramatically, because it is up tremendously, it's pretty clear then the only other part of that formula is extra spending. And we know extra spending is out of control. It's been out of control for decades, really, in a sense, if you count unfunded liabilities. But now it's really out of control, even on the books. Another point, and this is very important for investors, if Trump doesn't win, or if the Democrats control either the House or the Senate in the next election, then those tax cuts are extremely likely, but not certain, but extremely likely to expire at the end of 25, because it's going to require government cooperation to extend them or make them permanent. So this would be this would result in the largest tax cut in, sorry, going too fast, I'm always in a rush. This will result in the largest tax increase in U.S. history. I'll repeat that. That would be the largest tax increase in U.S. history. Wall Street Hackers predicts pretty clearly that such a large tax increase would likely put the US and the world into a recession, a very deep recession, very likely. Possible, hopefully not depression, but this is going to impact the economy because government will be sucking out more money out of the economy, and it will create a very negative spiral. If that happens, we'll follow the policy, but if it looks like those are really going to expire, we probably have to look at getting much more defensive in our portfolio, at least for the short run, until the market realizes how bad this is going to be if the government is sucking out that much taxes. By the way, the rates that are proposed would be much higher on corporations than those in China, England, or France, as we've covered in other episodes, and also capital gains rate possibly 44%, at least on some people. So this sucks money out of the economy. It's not good for the economy, for sure. Interesting story number 2. The chaotic protests at college campuses around the country appear to be, are almost certainly very well organized. How can you tell? Well, first of all, there are brand new tents at a lot of the protests. And if you look at the tents, they're matching colors. You have not one color, but they're like, wait a minute, why are there so many tents? And they're like uniform colors in green and blue and whatever other colors they are. There are brand new signs and, of course, catering. So who is paying for all of these expensive gifts? It's reported a number of liberal organizations that often fund protests, especially a lot of fingers in their news report to George Soros and his foundations that he donates to. Soros also is in the news, often accused of allegedly, whatever, funding prosecutors for election who refused to prosecute for many crimes. So the thing I don't get this is, what is he thinking? What is the Soros Foundation thinking? Are they trying to create chaos so that we become Marxist, or chaos so that there's revolution? I don't understand. It's so harmful. It's so destructive. And what's the end game? Do they really think that there's going to be some kind of Marxist nirvana that's created? Have they not seen a history of what happens when there are revolutions? Look at what happened in the communist revolution. It didn't work out like they proposed. A lot of these socialist and communist regimes get so much power, they become dictatorships. So I don't know why he's spending all his billions when he could just be giving it away to charity or helping in other ways the world. Interesting story number 3. The unsettling curse of King Tutankhamun's tomb in Egypt has long been feared to be linked to the mysterious deaths of multiple excavators who discovered it in 2022. In 1922, I don't know why I'm doing that today. It was discovered in 1922. Now a scientist claims to have resolved the mystery of the Pharaoh's curse. Apparently, toxic levels of radiation emanating from uranium and poisonous waste are believed to have lingered inside the tomb since it was sealed over 3,000 years ago. The radiation level inside Tutankhamun's tomb is so high that anyone who comes in contact with it could very likely develop a fatal dose of radiation. So mysteries are sometimes based in reality, and in this case, it seems like they've solved it. Interesting story number 4, a Bitcoin story. So on April 19th, Bitcoin halved, cutting in half the supply of new Bitcoins. This is very confusing to Wall Street hackers because the thing that was supposed to differentiate Bitcoin from other crypto was that they promised, quote, never to issue more Bitcoins. Now, I was on a prior show when I was just a co-host, and we had a Columbia professor on, and he said, this is why Bitcoin is so much better than other crypto. It's because Bitcoins will never issue more Bitcoin because Satoshi Nakamoto promised never to issue more Bitcoin. Now, here's the problem. Number one, nobody knows who Satoshi Nakamoto is or if he even exists. And apparently Satoshi Nakamoto, if he exists, has changed his mind. So as Wall Street Hackers always says, Bitcoin could go to $1 million or zero. It's total speculation. My guess is, for multiple reasons, it won't be worth anything in 10 years, but it could be worth anything. because it's, again, total speculation. But the thing is, more and more currencies, more and more countries are coming out with digital currencies, number one. And those, if you get a currency backed by a full country where you know who's behind it, and they promise not to issue more Bitcoin, then that would be more credible than Satoshi Nakamoto's promise. And also, there's a lot of issues with Bitcoin in terms of taxation, and maybe governments, if I was a government, I would stop it. I wouldn't have even allow it to go this far for a lot of reasons, because of black market use of it, drug dealers using it, possibly now they're talking about Iran possibly using it to fund things. And also, it's just underground printing of money, in a sense. Not real money, but crypto money. Anyway, we'll take a quick advertisement and we'll be back with the dividend pick of the week and our panel discussion. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
And we're back. So first, our dividend investment of the week, although this week it's more of an interest investment. We're going to discuss muni bonds and our strategy for muni bonds. First, disclaimers: Wall Street Hackers is for entertainment only. There are no guarantees on any investments, of course, except, bonds are fairly protected except for against interest. And also if you sell them early. No guarantees. These are only our opinions, and consult your financial advisor. So this week, muni bonds, and my answer is depends. This may be obvious, but what percentage of bonds you allocate in your portfolio is subject to so many factors, but mainly, your taste for risk. And each person has a different taste for risk. It depends on your market perspectives, age, tax brackets, and your goals. So it's hard to say, what percentage you have. Each person has different goals and different taste for risk. But for a long time, I liked muni bonds, and Wall Street Hackers' philosophy in general is to use bonds as a safe haven, a risk-free part, again, except for inflation, which we dismiss because that's as risk-free as you get. But it's a risk-free part of a portfolio, and that is obvious to those who are more sophisticated. But if you buy, by the way, the safest bonds, and that's our philosophy. Just take our risks in equity and other more speculative investments, and just have a safe harbor in the bonds. So that said, for a long time, Wall Street Hackers, and I'll say this slowly because there's a lot of elements, we preferred long-term to lock in interest, full state, backed by full states rather than localities, general obligation, muni bonds and general obligation rather than revenue bonds, because then it's the full obligation of that entity, makes it much safer. So that was our strategy. We like states, especially only safer states that we consider safe, like Texas, New Hampshire, North Carolina, maybe Washington, Georgia, Tennessee. Those were examples. But recently, Wall Street hackers dropped muni bonds from their model portfolio and went with long-term treasuries for two reasons. One, treasury rates have accelerated a lot, and muni bond rates have seemed to go in the opposite direction, oddly. So for some reason, a couple of years ago, you could get about the same muni rate, tax-free, at least federally, as you could get in a government treasury. But now, for some odd reason, I'm guessing demand for munis from mutual funds is my guess. I don't know why, but that's probably a good guess, or maybe individual investors. But now you can't get anywhere near that same parity. So you can get maybe 2 or 3% in a full state muni bond, whereas the treasuries for 20 years, 30 years are yielding, close to 5. So that's one reason. The other reason, which I really didn't like, and that was what moved me, is call provision. So muni bonds usually have call provisions, which gives the state the right to pull it in early. And basically, I feel like with our fears of yield curve control, if rates go down a lot, then these rate bonds are going to get called. So you can't control the call date. And if rates go up a lot, then you're going to be stuck with the bonds until maturity. So they were fine. But at this point, I'm moving towards treasuries because I want to pick the dates that I want to pick. And I like the high interest rates, especially obviously in an IRA. But that's enough for now because we have to get to the panel discussion. But we will get to discussing at least 1 or 2 strategies in treasuries next week before we get into specific dividend stocks again. So panel discussion. The question, where to invest for likely inflation and stagflation? First, I'm going to give a little background about what we have been discussing, and then we'll do a second section on some of the options, then we'll have the discussion. So number one, we've been discussing for the last 2 weeks the following. Government spending is totally out of control. The U.S. debt, unfunded liabilities for counting unfunded liabilities for Medicare and Social Security on a GAAP basis, general accounting accepted accounting principle, is roughly $125 trillion, not the $34.6 trillion that's discussed almost all over the media. The real debt is $125 trillion if you looked at it under GAAP principles, which is what a household or a business would have to use. The governments of the world are in the same situation. They have aging demographics and underfunded retirement plans. I've looked at a lot of them in different continents. And also they offer free healthcare. So it could be even worse because they have free healthcare and they haven't put money aside either. So governments are going to have to print money and then print more money and then print more money because there isn't enough money in the world literally to fund this. Not only can you not tax it, there's just not enough money. So they're going to be printing a lot of money and they're going to need interest rates and want interest rates to go towards zero. So they're going to use yield curve control, which I won't explain that. You can look it up if you haven't watched it on other shows or whatever. But basically, they're controlling long-term interest rates. And it's been done in World War II by the U.S. It's been done by Japan for over a decade. And it was recently tried out in Australia. So this is no secret to governments. They will not want to pay interest rates. Section 2. So that's what we've been discussing. Now, Section 2. So the 70s was a unique time in many ways in terms of soaring inflation. So it's a very good model for where you might want to put some or all of your money based on the 1970s results. Energy was the best sector in the stock market, but not the best performing fund. And as you know, Wall Street Hackers loves pipelines. We have about 4 to 4.5% in high-yielding energy producers themselves. Energy is a place you want to be if there's inflation. Defensive stocks like consumer staples and utilities didn't do that well, but it did much better than the overall equity market. The equity market itself, especially in real terms, did terribly during the stagflation that occurred. Real estate, interestingly, produced very strong returns also. Inflation can cause rents to rise while a company can keep their debt, fixed or pay off their debt. So it's very good, but Wall Street Hackers is very selective right now and has been in terms of REITs. So we love open air shopping centers. I think they're the most defensive sector. You get a decent, very high yield, and good safety. People need the communities shopping, and they're not going to abandon that. The malls, they could abandon a lot earlier than the shopping centers. But we also stay away from, first of all, office REITs because of office vacancies, which we've been saying for years. We actually talked about office vacancies. We were the only one for a year to talk about it, and now everybody's talking about it. For a year, I saw one article or a story about it, and I was saying there's going to be an office crisis. It just takes time sometimes to sink in. So we stay away from medical REITs, storage REITs, and for the same reason, because of possible conversion, and also and medical REITs because of possible conversions, and also nervous about apartment REITs. We're out of apartment REITs right now. Atlanta and Austin, Texas, have had pretty big decreases in rents. I believe I heard 8% decrease in Atlanta recently. And, in a tough economy, maybe people won't be able to afford even to rent as much. So, and there's a lot of building going on. That's the main thing. Gold was the best place in the 70s to have your money, but I'm not as confident this time for a couple of reasons. One, the correlation to inflation in gold is actually pretty low. I believe it's about 30%, depending on which study you look at. So it's not guaranteed. And two, I'm concerned about the links to Chinese economy and the Indian economy, but especially the Chinese economy, because they're big buyers of gold. And with AI coming, that could affect the Indian economy, and Chinese economy has had problems. So if they have a lot of problems, maybe the gold buying will, dry up. Silver, precious metals, you can do very well. Right now, I don't have a great stock play for that. And I'm not really a futures player, but it's interesting. Bitcoin didn't exist in the 70s, but I wouldn't touch it myself. It's very speculative. In terms of bonds, actually, short-term bonds did better than long-term bonds. I guess because you keep getting higher interest rates and you weren't affected. But if you're holding your bonds to maturity, you're always safe, obviously. But short-term bonds did pretty well because of the high interest rates on the short-term yields. But I like locking in long-term income. That's always been my philosophy to a point. And also, if yields go really low, those long-term bonds are going to be impossible to buy or replace. So, hey, Nick. So we're ready. So, Nick, we've been hurrying to get through. We have about 3 minutes, 2.5 minutes. We're always in a rush when we get to this. So what do you think, Nick? Take about a minute or a minute and a half, and I'll take a minute and a half.
About where to go during inflation? Well, real estate, I think, goes up during inflationary periods. But you are correct. Office space vacant. They showed the city of St. Louis, and it's like there's no one working there anymore because people are working out of their houses. And so office space could be a really bad sector. So it's not just real estate, it's what real estate, where are you going, et cetera. When it comes to that. Gold, there's no innovation in gold. There's no gold at the end of the rainbow. So I see no way gold can just spike up because it doesn't produce anything. It's like, I'm not real happy about that.
Gold is a non-producing asset, as Warren Buffett says, but I hold 1/3% in gold as insurance. Maybe I'll add someday. But it's not a big thing in the model portfolio. And also, you're right about real estate. The vacancies, like not touching it for a long time. I'm always looking at something like Highwood office, where they've got a fair amount of safety. But who knows how long this is going to go? It's really tight. So we only have 1 minute and 4 seconds. I'll take over and then we'll let you back in. Sure. So I had 3 conclusions. One, there is an economic wave coming. It's going to be more like an economic tsunami, unfortunately, most likely. People are ignoring it, and they're not looking just 3, 4, 5 years out, and it's starting to affect the economy now. The governments of the world need to realize that they should be taking action now. You don't want to be on the beach, as I say, when a tsunami comes holding an umbrella, and they're going to be unprepared when the catastrophe happens because they have done no planning. They've been talking about this for 30, 40 years, and they just kick the can down the road. But now the road is ending, unfortunately, not for, totally, but it's going to be really hard to deal with later. The other point is, as an investor, you need to consider real assets like pipelines, energy, open air shopping centers. You need to start thinking about locking in dividends. These are good strategies during good times and bad times, and we're out of time. We'll see you next week. And thanks for watching. As Kim says, get healthy and get wealthy. See you soon.
Next week. Bye-bye.